Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. A bit of a different video is talking about a portfolio I've set up that I'm going to put $500 into every single week and watch it grow. My investment style is generally pretty passive. Every other week or every single week, I throw money into ETFs, S&P 500 index funds, NASDAQ index funds, etc., in various accounts, brokerage and tax advantaged. But I also have a side account that is all active, and I talk about that more on this channel where I review stocks, find interesting valuations, etc. This is going to fall more on the passive side with some active management. Essentially what I've done here is I've set up a new portfolio that has about 40 individual stocks, all of them dividend payers, all of them dividend growers. And you may ask yourself, if this is a new portfolio, why does it have $62,000 in it? Well, initially this started as a S&P 500 Dividend Aristocrats tracking portfolio in 2019, 2018 actually. I put a bunch of money into it through 2022, but then kind of stopped putting money into it. It's grown from there. But end of day, I kind of got disillusioned with this strategy. There were a bunch of companies in here that kind of sucked, like Walgreens, etc., that I ended up selling around 22, 23, and then it sort of left it alone. Well, now I'm revisiting it because I have a bunch of money on the side that I want to put to use, and I want to do it in a fun, exciting way, and that is through this portfolio. So you can kind of look at the slices I've designed. M1 Finance allows you to kind of design slices. Money's going to go into these stocks based on its actual allocation versus its target. So I do want to revisit this every 3 months or so to make sure that these targets still make sense, that one stock that's consistently falling isn't just getting all of the money that's being contributed because it's a turd and I want to remove it from the portfolio, etc. So there's going to be some active management here, but in general, it's going to be relatively passive. So within these slices, I've got an industrials, materials, and other slice that's got various companies in that industry. I think all these companies have done relatively well. I've looked for companies that have had pretty decent total returns over the past decade, and I think can continue having pretty decent, potentially market-beating returns over the next decade. In the consumer goods side, you've got your common names, Walmart, McDonald's, etc. You can kind of see that the initial strategy of following the S&P Dividend Aristocrats still exists in here because a lot of those stocks have remained, but I have cut it down from 67 stocks in the S&P 500 Dividend Aristocrats portfolio to 40 or so, and there were a lot more deletions than just 27 because I've deleted more than half of that portfolio and then added other companies that I think are exciting, kind of like Costco, etc. And this doesn't mean that these companies are an amazing value right now or anything like that. Costco, for example, is very expensive, but it does mean that these are companies I want to own for the long term, and if they fall, I'd be fine with that because it would allow me to contribute money at a lower price point and essentially get a better valuation. As we look at the rest of these portfolios, you've got the financial slice. Some of these are private equity companies that I think are going to benefit from lower interest rates. And I think that's kind of the story here, the thesis here, if you will, that lower interest rates are probably coming. They've been, the Fed basically said that they're going to start cutting interest rates soon. And a lot of these companies, if you're a dividend payer, money might flow into your stock because, hey, interest rates are coming down, bonds are going to pay less, so people are going to start looking for alternative income sources. Two, companies like some of these private equity companies are going to benefit from lower rates as well for the same reason. People are looking for alternative sources and more money will flow into their managed accounts. So as you look at real estate, kind of the same thesis. They use a lot of debt to buy properties. They use a lot of stock to buy properties. And if debt is cheaper, they can buy properties at a better value than they have been in the past couple of years. And again, to speak to the fact that these aren't essentially amazing values right now, some of these stocks have already been rewarded for the fact that interest rates are going to come down pretty soon. You can kind of look at companies like MAA, which is an apartment REIT that I added maybe a month or two ago, and it's already up in the mid-teens since then. So a lot of solid returns here from these companies already because the market already expects the lower interest rates to come and is already rewarding the companies that are going to benefit from that prematurely. So essentially on the technology slice, I've only got 3 companies here: ADP, Broadcom, TSM, and Broadcom and Costco are the only 2 companies that exist in my individual stock portfolio as well. And the reason I don't have more in the technology slice is that my individual stock portfolio, if you've seen that before, I'll link it down below so you can see it. It's very technology heavy. I've got Apple, I've got Microsoft, I've got Amazon, Google, Meta, a lot of these growing dividend companies, if any of them pay dividends that you might consider as being a need in a portfolio like this, already overweight in that other portfolio. So I did not want to replicate that in here as well. Then you've got healthcare, which is AbbVie and Abbott, and you've got one energy stock, which is Diamondback Energy. And again, these are companies that I wanted to own for a while. A lot of times I looked at them and I said, well, they're a bit too expensive. But anytime you have that mentality, you might miss out on returns. And I just want to say, hey, I have a bunch of cash on the side, pump it into this. $500 a week isn't a huge amount of money, but at the end of the day, I think this is going to help this portfolio grow at a pretty decent clip. It'll be interesting to see, well, where are we at the end of 2024? Where are we at the end of 2025? To do these updates, to see that money flowing in and see what stocks I'm buying and how those dividends are growing. Again, I'll review those stocks here. If you want to look at them, I'll scroll down slowly. You can kind of see where they are where the allocation is. There's one stock that doesn't have a buy yet that's going to be scheduled with the next purchase. But then as we look at dividend income, you kind of see, the idea here is to grow this income to get overall total return. It's not just dividend focused. A lot of dividend stocks that people focus on are high yielding stocks that aren't necessarily going to deliver good total returns because their top line or bottom line aren't growing really quickly. They pay the majority of the free cash flow in dividends. They're not buying back shares. I want companies that are doing, not only are they paying dividends, they're growing at a decent clip. They're growing the top line. They're growing the bottom line. They're doing share buybacks as well, not just dividends. So the yield here isn't very huge. It's only about 2.1%, but I think it can grow faster than the market as far as the dividend payouts go. These are companies that are probably going to raise their dividends in the high single digit, low teens for quite some time. And then total returns are going to be hopefully market beating as well. So again, 2023 total income of 1165, 2024 total income expected of 1256, and the next 12 months we've got 1328. So I always like dividend income because it's just fun sometimes to look at. It's not necessarily the best investing strategy in my mind, but if you can kind of say, hey, in the next 12 months, I'm going to get 110 bucks per month from this portfolio that I have, and that's going to grow, and we'll see how quickly it goes. But right now, basically, my internet bill, my Netflix bill, and my Apple Music bill is paid for just by this account. That's kind of cool. And 2025, 2026, what else am I going to be able to cover with this account? Is it my gas bill? Is it my electric bill? Is it other stuff? Can I cover the majority of my costs by 2027, 2028? Because maybe I'll start putting more money into this portfolio if it's going well, and move other money around and just say, well, maybe we'll do 1,000 a week if we can afford that. Right now I probably can't because I'm not that rich, but at the end of the day, maybe when this channel becomes super popular, I'll make $7 out of it and I can throw it into the portfolio. So I'll be like, thank you guys for the $7 that I can throw into the portfolio. Right now this channel makes no money though, so that's really not going to happen anytime soon either because nobody watches. But thank you for watching if you're watching. So that's it. That's really it for the portfolio that I've designed here. Again, you can kind of see that I have a recurring transfer every single Wednesday. $500 is going to go into this portfolio. I want to see how quickly we can grow here. You can see obviously the growth stopped in 2023 where I really stopped contributing money, but it started to take off again as these dividend payers, as these companies that depend on lower rates have started to be already rewarded by the market. And really, that's kind of a bummer from the perspective of an investor like me, where I want lower prices for an extended period of time. So, I wouldn't be too upset if the stock market kind of takes a little bit of a dive in the coming months and years. Because I have so much cash, obviously my expectation for returns on a long-term basis are probably a bit lower than we've seen in the last 5 to 10 years. We've had a really strong bull market, but because selling at the wrong time means missing out on potentially massive returns, I still keep the majority of my money and will continue to forever keep the majority of my money in the stock market. That's why I have that 80% window, that 80% of my money has to be invested in the stock market. And I want to make sure that I stick to that. And doing something like this, where I can put money every single week into a portfolio like this one, is going to help me do that. And if the stock market keeps going up and up and up and up and up, no matter what I think, then I benefit from that. And if it falls a bit, then a portfolio like this, I think, will be more insulated than a standard portfolio that's heavy on tech, because people fly towards safer investments, and often dividend payers are seen as a safer investment. Doesn't mean that this portfolio won't fall a bunch. It still will, but it might kind of stay elevated a bit longer than some of these other stocks, some of these tech stocks. Maybe a 30% fall versus a 50% fall in the rest of the market. Still bad, but maybe not as bad. At the end of the day, though, I wouldn't mind a fall like that. I'm still very much in the investment phase of my account building. I want to buy stocks at a lower price point, especially stocks like this. High quality companies trading 20% lower than they are today are a better buy than they are today. if they're trading 20% higher than they would be if they fell, right? So especially on the dividend side, you get a higher yield, higher total growth expectations, etc. If the stock market trades at a 35x PE, then obviously the forward returns are a bit lower than if you were buying it at a 25x forward PE or a 15x forward PE. And any economic stagnation or economic problems would hopefully be short term, and the market would eventually recover, as it has shown to do in the last couple of recessions. So that's my thought process. Let me know what you think. Are you against any of these shares? Do you think I'm missing any companies that should be in here? Again, I'll scroll down really quickly here. You can kind of see what companies I have here. And ideally, this portfolio is going to have 40 positions when it's all said and done. I'd like to shrink that a bit more. I've already deleted, 35 plus companies and added a couple from that original S&P 500 portfolio, Dividend Aristocrat portfolio. So that felt like a good amount to start with, but I would like to continue to revisit this portfolio every couple of months to see, hey, am I still comfortable with some of these shares? And in the end, 40 stocks is a bit overbuilt for my liking. I'd like to have this portfolio be in that like 20 to 25 to maybe 30 position range. So I think in the future I will be deleting more stocks. So if you have any suggestions, let me know down below. But I do want to see more earnings reports from these companies. I want to see how they're doing. And I want to get to know more of these companies a bit closer, because I'm familiar with all of them, but again, some more than others. So I want to read some annual reports, etc. I feel like 40 stocks to read annual reports on is a bit too many. So if I can cut that down to 25, 30 or so, that's certainly a lot more reasonable in my mind. So let me know what you think. Is this a good idea, a bad idea? Do you think dividend stocks will do well in the coming months/years? Leave a comment down below, like the video, subscribe, etc. Like I said, this is probably a quarterly update at best. If you want to see more of these videos, more of these updates, let me know in the comments down below, but I won't make this a regular thing. I think I'll still focus on individual stock analyses, which is kind of what I like to do on this channel. So hopefully you like watching that as well. But if you want to see more of this type of stuff, let me know, so I can kind of rejigger the channel as needed. Leave a comment down below, like, subscribe, all of that good stuff. Bye. Thanks for watching. Bye.